Teledoc rhymes with trucker. Welcome back to Strongman Personal Finance. So apparently Teladoc's going to the moon. That's right, ladies and gentlemen. Teladoc stock just had some earnings. So we're going to go and do some investigation because I have talked about Teledoc, my truckers, you know what, for quite a amount of time. I've actually been slightly interested in the stock. Why? Because while it's been pretty unprofitable, and I don't think it's ever made money, it has some interesting things going for it. And it's actually getting close to profitability. Not as fast as I would like it to be, but it's approaching profitability. So let's go look at Teledoc. It's up 27%. Oh my God. How much has VT gone up in the past year? Like 13%, something like that? Freaking lame. So we can see the stunk has gone up. However, the stock is down massively from its all-time highs. Oh my God. Look how high this stock went. That looks like a trucker's you-know-what. All the way up to almost $300, and now it's trading at $28. This is why you don't buy unprofitable companies, because if they go up in a clown market like that, which we had, they can fall, and there's no underpinning to those companies. So we can see some statistics here. We got a market cap of $4.73 billion, revenue of $2.53 billion, net income negative of -$4 billion. Now you look at that and you're like, holy crap, this company is massively, insanely, disgustingly unprofitable trash. Well, you'd actually be mistaken. The reason that's the way it is because they had Goodwill impairment. That's right. What is Goodwill? You buy another company for more than the fair value of its net assets. You got to debit something on the journal entry. So what do you debit? Goodwill. It's an asset account. Intangible, indefinite lived intangible asset is what it is, or something like that. But basically, it's just this thing that sits on your balance sheet. But if the company you bought turns out to be hot freaking trash and it doesn't or isn't going to produce what you thought it was, and you expect the future cash flows to not be what you thought they were, you have to write down the goodwill. And that goodwill goes from the balance sheet to the income statement, which is why you see this massive loss. They had a huge acquisition. But what was that company they bought? I forgot. But they bought a company, and they had to do a massive, I think it began with L or something. They had to do a massive write-down because the company's future cash flows that they acquired weren't what they expected to be. I think it was Labongo, as a matter of fact. Labongo, Madongo. Now, here's an interesting thing. It's got a forward PE. The company is expected to be profitable in the next year. And if this company becomes profitable, is it going to come up like Palantir? Well, if they say AI a couple times, maybe it will. But I can see this company becoming profitable at some point. I can see it. Okay, there's a path to profitability. Now, there's a price target for analysts of $32.55. Now, let's go ahead and look at the historic financials. So we could see revenue by Evenue. It is massively slowing down in its growth rate. They had explosive revenue in 2020. Why is that? Well, this is an app where you can FaceTime a doctor. What happened in 2020? Yeah, okay. But it's still a pretty cool concept. However, the revenue growth rate has massively slowed down, okay? From growing at 80% year to year, they're down to 10%. Very, very slow, or slower than normal, okay? Wow, they already updated the earnings on here. That's pretty impressive. Let's look at margins. Gross margin, basically steady. Operating margin has been negative. Now, we see this one spike of operating margin right here. That was some kind of, I don't even know what that would be. But that was probably some kind of one-time revenue or one-time charge. Because we can see the profit margin, it's been negative every single freaking time. I'm sure I covered that quarter. I don't exactly remember why their operating margin was positive. But their bottom line profit margin, because of the Goodwill impairment, was massively negative. And you could see they had a couple impairments. They had one here. When you see a loss like that, it's either the company's a massive clown company or there's a Goodwill impairment or some kind of one-time charge. So we can see there was a charge here. We can see there was a charge here. We can see there was a charge here. So when you're looking at the company, even though those charges matter, you might want to say, hey, maybe I should exclude those charges when I'm doing my analysis and see what the company's profitability is, net of those one-time charges. Because at a certain point, if they have to write off all their goodwill, they're going to do it eventually. And eventually the goodwill is going to be zero. Okay. So they're still unprofitable, but they are growing revenues and they are approaching profitability. They are getting closer to profitability. Okay. You can see in the quarters where they didn't have a charge, they had roughly -10, -11%. So they're slowly making their way to profitability. Free cash flow margin, actually pretty freaking bad this quarter. I wonder why. Let's go look at their cash flow. So we could see they've generally had positive operating cash flow, except for this last quarter. We'll go look at why in a second. But that's a sign that they have a lot of non-cash expenses. Most probably share-based compensation. Oh, look at that. They've had stunk-based compensation up until the most recent quarter. That's interesting. Okay. And they've had no capital expenditure unless this didn't update. They had no capital expenditures this quarter. We're actually going to look at the financials. This may not be updated. That may be incorrect. So let's go ahead and look. Second quarter revenue grows 10%. That's pretty good in this economy, right? Second quarter operating cash flow. Okay, so the website was wrong. This was wrong. This is why you have to go look at the financial report and what's not updated. They had positive operating cash flow and free cash flow. So they are cash flow positive. If they are cash flow positive, but they continue to have losses on the accrual basis of accounting, there's some kind of non-cash expense that is reducing their profitability. Probably stunk-based compensation, okay? But when that runs out, they might be profitable. I don't know. We'll go look at the statement of cash flows. Second quarter net loss of $65 million or 40 cents per share. So on the accrual basis of accounting, they're still losing money. Teledoc continues to set the standard for delivery of innovative, whole-person virtual healthcare solutions to an ever-demanding marketplace focused on the intersection of quality and cost of care. Blah, 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 blah. So basically, the CEO's fluffing the company. Now, let's go look at some vertical and horizontal analysis that I did. So vertical analysis is where you're looking at a financial statement. You're looking at an income statement, for example, and you're looking at what percentage of total revenues is each line item on the income statement. For example, here's the revenue. This is the revenue for the 3 months ended June 30th, 2023. This is the revenue, my avenue right here. Okay. $652 million. I'm going to take all these other numbers, all these expenses, take these expenses and divide it by the revenue to tell us what percentage of revenue is each expense. And the reason we can do that is just to see what is consuming most of this company's profitability. What is the biggest expense this company has? So we could see that right off the bat here in the blue, revenue is 100% of revenue. Their cost of revenue is only 29% of revenue. So they have a 70 point something percent gross margin. They have a very high gross profit. That tells me most of their expenses are either in their operations or interest or taxes or some kind of one-off charge. But they have a very high gross profit, unlike Tesla, which does not. So advertising and marketing consumes 27% of revenues. That's right. 27% of revenues is consumed by marketing. 8% by sales, 13% by technology and development, and 19% by general and admin. We go down a little bit more. Acquisition, integration, and transformation costs, less than 1%. Restructuring costs, that's a new charge, 1%. And depreciation and amortization, non-cash expense, that is almost 12%, right? So their total expenses are 110% of revenues. That means they have an operating loss. Now, this restructuring cost is a one-time thing, I think. Okay, I didn't see it on the prior quarter. You see, there's nothing there, right? There's nothing there. So I said, okay, if we take out the restructuring costs, because it's theoretically a one-time thing, what would their operating margin be? Well, their operating margin would be negative 9.83% if you excluded the one-time restructuring costs, okay? So they're losing money. All right, they're losing money, but it's not the end of the world. It's kind of like Palantir, how I think about it. You know, they have a lot of non-cash expenses, which makes them GAAP unprofitable, but they do have positive cash flow, so they're not going to go bankrupt, okay? Now, let's look at something else. Interest income. Now, we're going to look at something interesting about interest income here, okay? But we'll talk about that in a second. Interest expense, immaterial, and their total net loss was negative 10%. So overall, they're losing money. In this column here, this tan column, we're doing horizontal analysis where we're comparing two different quarters. So we're comparing this quarter to this quarter. So what it does is it tells us how quickly the revenue or expenses grew. So for example, the revenue grew by 10.13% for the quarter ended June 30th, 2023 versus the quarter ended June 30th, 2022. So year over year, 1 year in the future from the last quarter, their revenue has grown by 10%. So they're still growing revenue. We saw that in the overview, okay? Sales and marketing has grown slower than revenue at 8.62%. They've cut sales costs. Sales costs have actually gone down by 7.6%. Technology and development has grown a little bit faster than revenue, but nothing crazy. And general and admin has grown a little bit faster than revenue at 11.37%. But they're definitely saving costs here and looks like directing some of it here to tech and development, but no crazy explosion of costs, okay? Acquisition, integration, and transformation costs. Now, those are up 75% from $2.8 million to $5 million. Depreciation amortization is up by 27%. That's a pretty significant change, okay? Depreciation and amortization are up. That means they've either spent a lot on tangible assets or intangible assets. And when you buy capital assets, you have to expense them over their useful life. Next, we have negative 100%. This is their goodwill impairment. So in the quarter ended June 30th, 2023, they wrote off $3 billion of goodwill. They had an enormous loss in that quarter, negative 500-something% loss because they wrote off the goodwill. That did not happen in this quarter. So if you were just looking at this company and you were like, well, their loss from operations was negative 97%, but this quarter their loss from operations is negative 10%. Oh wow, that's such an improvement. Well, guess what? Their loss isn't really as bad. The loss in that prior quarter really isn't as bad as you might think. Because if you take out the goodwill impairment, which is a non-cash charge, their profit margin or their loss was, where was it? Let's go over here and look. Their operating margin net, excluding that goodwill impairment, was negative 11%. So if you're looking at non-cash, excluding non-cash one-time charges, their loss improved from a negative 11% to negative 36%. Now, the last interesting thing I saw was interest income, which is up 843%. That's not a surprise. Okay, interest rates have gone up, but that will make their profitability look a little bit better. But I wouldn't even count that because interest rates can go down. So that's the income statement. So the main things I see is interest income is up. Revenue has generally grown faster than expenses, but their fastest growing expenses look like depreciation and amortization. And they have they're spending a lot more on acquisition, integration, and transformational costs, but they're not significant, okay? So they've been buying a lot of long-term assets or intangible assets. So let's go back and read the report a little bit more. Okay, so let's go see if their financial statements are on here. So we just looked at this income statement. Okay, we saw that they're cutting costs a little bit here and there. And if you exclude the one-time charges, their profitability is slowly improving, but they're still unprofitable even if you exclude one-time charges. Okay, but they're making their way there. Let's see. Stock-based compensation. Stock-based compensation for this quarter is $55 million. $55 million. It's actually up from the prior quarter. And I'm pretty sure that's because it's tied to the stock price, I think. But overall, even with stock-based compensation, they would still be unprofitable. Even if they didn't have any stock-based compensation, they would still be unprofitable on a GAAP basis. So it's not really like Palantir in that sense. But overall, I mean, they're close to profitability. They need to cut some expenses. I mean, they're spending a lot on advertising and marketing. That's a big line item right there. I don't know why they need to spend that much, but whatever. If they could cut that a little bit, maybe cut into general and admin a little bit, that's where I would focus my cuts on. They might be able to swing a profit at some point, but hey, whatever. So where does their revenue come from? Well, it looks like it's from access fees is the vast majority of it, and other. Revenue by geography. This is interesting. Their U.S. revenue grew 8%, but their international revenue, international bro, grew by 28%. That's interesting. Now, the U.S. revenue is still the lion's share, but international revenue is growing. And I'm curious, it's probably growing faster than you might think, because if they're converting this revenue into dollars, since the dollar is stronger, it's converting into fewer dollars. So that means international revenue is actually growing a lot faster. If it was all based on dollars, it's growing a lot faster than 28%. So they're definitely expanding their international business. Let's see. Total visits. That's interesting. So their visits have stayed flat. That is very interesting. Their total visits have stayed flat. Wow. Okay, let's see. Operating results by segment. BetterHelp. I did not know they own BetterHelp. That is interesting. Teladoc Health Integrated and BetterHelp. So let's see. Yeah, BetterHelp's pretty significant part of their revenues. I did not know they own Better. See the things you learn reading these financial statements, okay? So apparently a big chunk of their revenue, almost half their revenue, comes from BetterHelp, which some people say is a scam, but whatever. All right, let's go ahead and look at the statement of cash flows for 6 months into June 30th, 2023. So they have, okay, depreciation, amortization. That's gone up pretty significantly. Depreciation of rental equipment. Let's see. I'm trying to see if there's any big changes on here. Accounts receivable. So they're subtracting it. So that means it went up compared to the comparative quarter. Prepaid expenses went. Okay. They accrued some prepaid expenses. Inventory is an add back. So they sold some, went down on the balance sheet. I'm trying to see if there's any crazy changes. I don't see any. Well, here, accounts payable. So there was a change in accounts payable. I mean, sometimes it's like quarterly things. They wash each other out. But overall, their operating cash flow is up pretty significantly. Okay, so that's a positive thing right there. Can't really knock it. Okay, so they have positive operating cash flow, and they have positive free cash flow. Okay. And most of their spending goes to capitalized software. They're not spending a lot of money on like buildings, property, plant, and equipment. They're spending most of it on capitalized software. But even with that, they have positive free cash flow. Financing cash flow, mostly from stock, basically all from stock options. So they're issuing some shares, but they're not like massively diluting. It's employees exercising their stock options. Let's see the balance sheet. All right. Very solid amount of cash, and they have positive operating cash flow. They're not going bankrupt. Accounts receivables, roughly the same. Inventories are down a little bit. Prepaid expenses are down a little bit. Let's see. Okay, they really didn't buy much property, plant, and equipment. Goodwill's the same. Goodwill's still at $1 billion, but if that gets written down, that's a pretty big expense that could hit their financial statements. Intangible assets actually went down because of amortization. Leases decrease a little bit in other assets. So overall, the biggest changes I see in their assets section are none, really. There's really not that many crazy major changes in their assets. They have a huge cash pile. They have over $1 billion of cash and receivables. They're not going bankrupt. Let's see. Accounts payable, very small. Accrued expenses, nothing crazy. Total, they are not going bankrupt. They have an outstanding current ratio. They have enough cash to pay off, as a matter of fact. Let's see. What are their total liabilities? Does it tell us? Let's see. Their assets minus their equity. They have $2 billion of liabilities and $4 billion of assets. Okay. They do have these convertible senior notes. That's a pretty significant debt that they have on their balance sheet. When that comes due, I don't know what they're going to do with that. I don't know if they're going to refinance it. Probably. because I don't think they have enough. They don't have enough cash to pay it off all at once. But overall, their balance sheet isn't the worst thing. Now, the only thing I would be concerned about is if you take out their intangible assets, because remember, they're spending on acquiring another company. They still have $1 billion of goodwill on their balance sheet. And then they have capitalized spending on software. So they spent a bunch of money on software, but instead of expensing it, they put it on their balance sheet, and then they're going to expense it over its useful life. But these are intangible assets you can't really touch, okay? So if you take out the intangible assets, so let's say they impair all of their goodwill gets impaired. Well, if all their goodwill gets impaired, they still have more assets than liabilities. But then if you want to just look at the tangible assets of the company, they have fewer tangible assets than liabilities. So these convertible senior notes are definitely something you should watch. That $1.5 billion of debt is a lot. Okay. And a lot of that was probably spent on buying that clownish company Livongo that they had to write down. So I would watch this very closely. That's what I would be most concerned about with Teledoc. I mean, even if they impaired the goodwill, it's not going to collapse the company. It's not going to make the company go bankrupt, but it would still be very concerning because that means the future cash flows aren't as great. So let's see. Is there anything else interesting on here? Yeah, so overall, I mean, they've cut expenses a little bit, but they're still a decent way from profitability. They're cash flow positive. They're not going bankrupt anytime soon, but they are not profitable yet on a GAAP basis, and not even because of stock-based compensation. Now, I want to read more about those senior convertible notes, but I don't think they have them here on this. So if you want to do further research, you want to look into these senior convertible notes right here. Convertible senior notes, and see when they're going to come due. Because if they're coming due soon, all of a sudden their current ratio goes from really good to not so hot. So that's it for Teledoc. Any questions? Let's see. We love you, strongman. Livongo, my jiggly dongo. Teledoc to the moon. I mean, they can't seem to make money. They spend a lot of money on advertising. Jerry's going to make a gloat video with Meta. I can smell it. Zuck, the you-know-what, just started the verbal AI trick going around, which is remind me of crypto. All miracles become commodities. Yeah, I don't really care. Lefebvre's a genius, obviously. My Lyft stock going up today. Sold all 7,535. You have 7,535 shares of Lyft? What is wrong with you? What kind of illness do you have? Don't know what Teledoc is, but trying to get a doctor's appointment where I live is near on possible. I'm guessing that's the model online doc. Yeah, I've used it before. You can literally just like FaceTime a doctor. I mean, it's not the most moti thing because there's other apps out there. But I did not know they own BetterHelp. That is very interesting. I don't know how I missed that because I've looked at the company before. Like they always just focus too much on the financial statements. But yeah, that's a pretty big chunk of their revenue. How having Zoom calls with your parents does make you a high-tech company? It doesn't. It doesn't. It got super popular during the pandemic, but it doesn't make money. It doesn't make money. Let's see. They own that BetterHelp online therapist thing you hear about advertised constantly. Yep, we learned that. Let's see. How does anyone listen to Crashy Woods? Because she's a genius, bro. Teledoc is the biggest player in a relatively new... Well, I mean, there's two main concerns. They don't make money on the accrual basis of accounting. Their management makes horrible investment decisions. They have that big debt, those senior notes that I would be concerned about. I would research those. There's a couple things that aren't really that great about Teledoc. And plus, at the end of the day, how hard is it to make a company that, lets you FaceTime doctors? I mean, is that really like an unbreachable moat? I don't think so. Let's see. I mean, 28 for Teledoc isn't terrible. I mean, if you're looking at it from like a ratio standpoint, what's the price to operating cash flow? Let's see. All right, there's something wrong here. I mean, obviously the ratios here are negative. I don't think they're negative in reality. It's probably because the freaking data hasn't loaded yet. But you'd have to look at it. If you wanted to value it, you'd have to look at the price to cash flow, price to books. I'd maybe exclude the intangible assets. I mean, price to sales. I mean, it's not the most expensive clownish thing I've ever seen, but they don't make money, and they just can't seem to make money. Like, is it that hard to cut some advertising? Let's see. This would be a good example when non-GAAP. I agree. I mean, if you want to really look at the core changes of the company, you can't compare the quarter with Goodwill, with a Goodwill impairment to the quarter that they just had. You can't do that. They had Goodwill impairment charges. Yes, they did. They paid a lot of money for an investment that did not make a lot of cash. What happens when Medicare blows the private medical industry out of the water in years to come? I thought the USA ruling. No, we're not. No, we're not. Kevin said he will start providing paid financial advice for reasonable fees. Yeah, I'm sure you need his financial advice so badly. Let him build your let him build your grandma's stock portfolio. Is Teledoc a thing where you speak to a nurse on a phone in exchange for money and she totally sorts you out? I think I spend way too much money with Teledoc. You call a Teledoc for a little bit of pleasure? I'll show you a couple websites. You don't even have to pay Teledoc. You can get it for free. Let's see. Why didn't you buy AT&T? Because why would I buy that with an unknown lead cables liability when I could just buy VT? BetterHelp is going up in flames, is it? Strong man, if you had talked great futuristic things about these stocks instead of bash them, then you could have been a million. That's true. That is true. I could be a very rich man. Instead, I'm a little wagey that goes to his wagey job and does wagey things. I'm a loser. How many millions of dollars does Meat Kevin's ETF have? I think I heard him say trillions. He's made trillions. Not sure how sticky their business is. If companies lock in and don't stick, they might have a chance. I don't see a huge moat with this company, to be perfectly honest. Boeing can't make money. They lost list. Yeah. I don't know why people have to buy these money-losing businesses. Like, why? Just buy something else. Try TRT, get swole. I'm naturally swole. VT beat VTI. Oh, did it? Let me pay you. You should. You should pay me a lot of money. Look at BetterHelp. Problems and scandals. Yeah, maybe I'll research it more. All right, well, that's Teledoc. Still losing money. Not going bankrupt anytime soon. I don't know when those notes are maturing. They'll probably refinance them. Nothing special. I don't know why the stock went up massive. Oh, they beat. I mean, they're still losing money, okay? All they do is freaking lose money. It's just that hard to understand. All right, cheers.